like to show you something because I've been trading now and investing now for over 20 years, and one of the things that I've really discovered about the markets is that there are waves of buying and selling coming into the market. It's never just all buying and all selling, because if everybody's buying, who's left to sell, right? So eventually, when everybody is very bullish and everybody is buying stocks, it leaves a void in the market, and that is, the void is that sellers step up to the plate because a lot of people either have profits that they want to take by selling into the market, or they have an opinion about the market and they think it's too high, so they come in and sell. And what MarketXFactor does is allow you to measure the amount of buying and selling coming into a market on a fixed scale. So in other words, can't go below 0. In other words, it can't be a negative number, and it can't go above 1, which is an absolute. If it does go to 1, it means that there are only buyers or there are only sellers in the market. So, and when it goes to 0, it means that there are no buyers or no sellers in the market. I'm going to show you exactly how that works here on the video. MarketXFactor uses market internals, it uses volume, it uses the number of issues, advanced declines, and some other factors that go into this formula. And what I like to do is show you how you can use it in order to gauge buying and selling, and then also how to use it for trading. It's really cool, because what it does is it gives you an edge. And if you believe in the idea that markets are manipulated by large players, or that there are in fact people who are inside and who know what's going on in the markets, well, this is about as close as you can get to actually finding out what their edge is and when they're going to step up to the plate to either buy or sell stocks. If you don't believe that the markets are manipulated and they're totally free markets, that's fine too, because what a MarketXFactor allows you to do is determine when those waves of buying and selling come into the market, so that you can position yourself and your portfolio correctly. This is a short-term indicator. I should also make that clear, is that it's not something that's going to tell you where the market's going to be 6 months from now or even a month from now. It's a short-term indicator. I use it on hourly charts. Now, you can use it on a 15-minute chart. You can use it on a half-hour chart. You can use it on a 2 or 4-hour chart, which ThinkorSwim allows me to do. But I use it on an hourly chart, and I get the best results with that. Now, it's a 4-line indicator. And I should also let you know that it does not, it doesn't smooth anything. In other words, it's not an average of the market internals. It's not an average of anything. It's a highly correlated to price indicator based on actual market action. It's in real time, at least the way I have it set up here in my ThinkorSwim platform. So it does not smooth. It's not taking an average of any of the internals that it's measuring. It doesn't smooth it out. It's not taking a 2, 3, 4, 5, 10 period moving average of anything. It's actual real-time raw data that calculates whether or not buying or selling pressure is coming into the market. And it does that in 2 ways. Number one is the blue line here. The way I have it set up, I have it set up with a blue line. And if you look at the videos on how to set this up, it's very, very easy. The blue line measures the amount of buying coming into the market. It will tell you that there's a tremendous amount of bullishness. So as we get closer to 1, which is the maximum value for the buying here and selling, it means that, for example, in this case, we hit a peak of 0.9468. And you can see the value right in this blue area here in that box as I hover my mouse over that peak. That means that the buying pressure here is at an extreme level. 1 is the maximum. So 0.9468 means that there's only 6% left in the market in order to buy. I mean, there's not much room left. I mean, the buyers have spent a lot of money to push stocks higher. You can see that stocks actually moved quite a distance here, between 8,200 and 8,400 for the period that I've got marked here on a one hour chart. And you can see that the buying pressure was fantastic here. It was at 9.9468, which is almost at 1. Very little selling pressure coming into the market. However, When it gets to those extreme levels, what happens is it leaves a void. So the yellow line at the bottom measures the amount of selling pressure coming into the market. So you can see then when there is really not much selling pressure based on market internals, and we do a couple of different calculations here, but basically what it's doing is measuring market internals as to the selling pressure. There's hardly, well, I would say very little selling pressure here, because you can see that by the indicator here, if you take a look at this box, it'll show you that it's only at 0.05. That means there's very, very little selling coming into the market. Now, once we reach the 75% level, I'm looking for buying to peak. Once it crosses the 50% level, which is represented by this red line that goes through the center of the indicator, that's pretty much where you want to see a rising trend of either selling or buying coming into the market, and that's where you want to take your positions. But you can also take positions. I mean, normally what will happen is you want to see a peak. Double peaks are best, but usually you want to see a peak of buying pressure. And it doesn't mean that you need to sell your positions at that time, but it does mean that you need to be aware of the fact that there's a void of selling, and selling could easily come into the market to disrupt it. Now, what happened the very next day, each one of these is a day here, separated by these lines. You can see Tuesday, Wednesday, Thursday. This was Monday. On Tuesday, we did get some selling pressure coming into the market. And you can see that the yellow and the pink line are actually part of the same indicator, representing selling pressure. The blue line and the gray line are part of the same indicator measuring buying pressure. But when they separate, it means that there's a lot of issues that are going down, but there's very little volume. In other words, the yellow indicates how much selling pressure in real terms and real dollars there is going into the market. And the pink line, it represents how many issues are actually being sold off at the day. And you can tell that when they separate, and the fact that there is a lot of selling going on, but there's very little volume. So that's an important aspect of this, is the four lines, is that when you see that, in fact, there's very little volume going into the decline, you can tell that probably some buying will come back into the market. And that's exactly what happened towards the end of the day here on Tuesday and into the next day. The buying went above, again, the 50% level, and buying stayed relatively consistent throughout the day. However, a troubling aspect of both of these days was the fact of the separation of these lines, so that there was more volume going into up stocks than really the stocks themselves. And normally you want more volume. You want volume behind the move. But what happens is, if you take a look when buying or selling pressure is coming into the market, so in other words, we've got a lot of buying pressure up here. We've got buying pressure here. You could tell that selling pressure was starting to rise here, especially on this large bar. So if you use it in conjunction with candlestick charts, especially, and this is the way I use it. This is a huge reversal bar based on this. You could tell that selling was beginning to rise based on the yellow lines, and that the selling would come into the market. So that was a nice trade there. Even if you got in at the end of this bar, right around the 8,500 area of the Dow, and went short, you could cover once you see the selling starting to flatten out here.